Welcome to this explainer. Okay, picture this. You've just hit the withdrawal button on your crypto exchange. You're staring at the screen and absolutely nothing happens. If you've been there, you know the instant spike of panic that follows, right? It feels like your funds have just vanished into the digital ether. But today, we're setting all that stress aside. We are taking a calm, structured, and totally analytical approach to demystify exactly why crypto withdrawals and fiat cashouts fail. We're going to pop the hood on these exchanges, blockchains, and banking rails to figure out exactly where your funds might be stuck, and more importantly, why. Okay, let's dive into this. We'll start with a big question. Where is my crypto? Then we'll explore the no TxID scenario, how to navigate the blockchain, and the friction caused by account limits and fiat delays. Finally, we'll cover some severe warning signs and wrap up with actionable steps to actually protect your funds. All right, Section 1, where is my crypto? Let's track down those missing assets.
It's a completely valid question. You click withdraw, your balance updates instantly, but your receiving wallet is just sitting there, completely empty. The anxiety is totally real. But listen, the vast majority of these situations have a clear, logical explanation that comes down to operational protocols. So, the absolute first question you need to ask yourself is this: has the exchange created a TxID? This transaction ID is literally your ultimate diagnostic anchor. Knowing whether you have one or not instantly tells us if the problem is stuck inside the exchange's own internal systems or if it's out there roaming the public blockchain. And this brilliantly illustrates the fork in the road for diagnosing any delay. If you don't have a TxID, you're dealing with an internal exchange issue. The exchange hasn't even let your crypto out the door yet. On the flip side, if you do have a TxID, it means the exchange successfully handed the transaction off to the decentralized network. Trust me, knowing which side of this divide you're on is half the battle won. Moving to Section 2, the no TxID scenario. Let's dig into those internal exchange hurdles. So if your withdrawal says pending or processing, but there's no long alphanumeric TxID anywhere, your crypto literally hasn't moved yet. Now, often this is just due to routine internal housekeeping. An exchange might be running scheduled wallet maintenance or upgrading their notes. Sometimes it's what we call a hot wallet shortage. Think of the hot wallet like an exchange's cash register. It's internet connected and active. If it temporarily runs out, they have to securely move funds over from their offline vault, known as cold storage. Other times you might have triggered an internal risk control queue for manual review, maybe because it's an unusually large withdrawal or it hit an anti-money laundering check. You could also be blocked by unsettled fiat deposits or even a security cooldown. You know, like if you just reset your password or updated your 2FA, exchanges will automatically lock withdrawals to protect you from hackers. It's super frustrating, for sure, but remember that most of these are totally normal, temporary, and actually there for your security. So the crucial point here is understanding the difference between your total balance and your withdrawable balance. Your withdrawable balance strictly excludes funds that are locked up. We're talking about open limit orders, collateral for margin positions, or funds tied up in staking and earn programs. Honestly, it's a remarkably common mistake. You might see a total balance of 1 Bitcoin on your dashboard and try to withdraw the whole thing, completely forgetting that half of it is locked up in an active sell order you placed 3 weeks ago. Section 3, navigating the blockchain. Let's look at what happens out on the network. Okay, let's flip the scenario. The exchange has generated a TxID, so your transaction is officially out on the network. But your receiving wallet is still empty. What gives? Well, the most likely culprit is a mempool backlog. Think of the mempool like a giant digital waiting room for unconfirmed transactions. When a blockchain gets incredibly busy, this waiting room fills up fast, causing major network congestion and spiking those gas fees. If the exchange's algorithm didn't attach a high enough fee to your transfer, network miners are going to prioritize other better-paying transactions, leaving yours just sitting there pending, sometimes literally for hours. Other technical snags outside the exchange's control might be hard forks, chain reorganizations, or token migrations that temporarily shake up the network. But wait, what if you punch that TxID into a blockchain explorer and it actually says confirmed? If the blockchain says it's confirmed but your new wallet is empty, we have to talk about user error. Did you pick the wrong network? Like trying to send a token over Ethereum when the receiving address only accepts Polygon. Or maybe you forgot a required memo or destination tag, which is absolutely critical for assets like XRP. Another common one, sending funds to a totally unsupported asset address. And finally, if you successfully sent the crypto to another centralized platform, that receiving exchange might be holding the funds internally to run its own compliance checks before they actually credit your account. All right, Section 4, account limits and fiat. Let's navigate those cash out hurdles.
Now, what's really interesting about this slide is a stark contrast between two very different worlds. We've talked a lot about the technical side of moving crypto, but cashing out to traditional fiat currency like US dollars or euros brings in a whole new set of legacy headaches. Look at the crypto account limits. Those are algorithmic. They are strictly tied to exchange policies, like your daily withdrawal caps, your KYC tier, or regional travel rule checks. But then look at the fiat cash out hurdles. Suddenly, you're crashing headfirst into the traditional banking system. We're talking bank holidays, weekends, third-party payment processor crashes, or strict name mismatches between your exchange and your bank account. Sometimes an exchange just loses its fiat banking relationships out of nowhere. You're basically stepping out of a 24/7 digital environment and hitting a wall of traditional 9 to 5 banking hours. And there's another sneaky risk to keep in mind here. Stablecoin depegs and paused conversions can easily trap your fiat value, even if those traditional banking rails are working flawlessly. If you rely on just one single stablecoin or one specific conversion route to exit your crypto, you're taking on a very unique liquidity risk. If that stablecoin suddenly loses its peg to the dollar, the value of your cash out could plunge before it ever even reaches your bank account.
Which brings us to Section 5, Severe Risks and Warning Signs, the really serious systemic issues.
All right, taking a step back from standard technical glitches and banking delays, we objectively have to look at the very top of the risk pyramid. These are the catastrophic warning signs where calling customer support simply isn't going to help. If you ever notice broad, completely unexplained withdrawal freezes across multiple different assets at the same time, no way around it, that is a massive red flag. It often points straight to exchange liquidity shortages or worse, full-blown insolvency. We also have to acknowledge the reality of catastrophic wallet hacks, insider fraud, or legal actions like international sanctions and law enforcement freezes that can totally paralyze the platform. And at the absolute worst-case extreme, there are malicious exit scams, where the operators literally just vanish with everybody's money.
Actually, I want to highlight this specific quote from our source material because it is absolutely crucial. The most dangerous fraud-related cases involved vague maintenance excuses, disabled support, and pressure to deposit more money to unlock withdrawals. Please burn this into your memory. A legitimate regulated crypto exchange will never, ever ask you to deposit more money just to release funds that are supposedly frozen. If you ever face that kind of pressure, it is a glaring, undeniable sign of fraud. Full stop. Let's move to Section 6, How to Protect Your Funds. Time for some proactive, practical defense. Let's see how this builds into a solid defense strategy. Now that we know why things break, here is your prevention checklist. Step 1. Get your KYC verification done early and always check your withdrawal limits before you actually need them. Step 2. Test any new withdrawal route with a tiny amount of crypto first. Verify the network, check the memo, make sure it lands safely. Step 3. Document the whole shebang. Keep your screenshots, save those TxIDs, log your support tickets. Step 4, maintain multiple fiat off-ramps. Never ever rely on just one exchange to link to your bank. And Step 5, simply avoid keeping large inactive balances sitting around on centralized platforms. We also need to put a very clear, unambiguous risk warning out there. Crypto trading and holding assets on centralized exchanges inherently carries significant technical, regulatory, and financial risk. Whenever you use these platforms, you are making a choice to trust a third party to custody your digital assets. And as we've explored today, that trust exposes you to their operational hiccups, their banking relationships, and ultimately their financial health. Which leaves us with a pretty provocative thought for you today. Is your crypto truly yours if it's just sitting idle on an exchange? Think about it. If a central authority can pause your withdrawal for maintenance, lock it for a manual review, or freeze it entirely if they go insolvent, who really holds the keys to your wealth? Understanding exactly how and why withdrawals fail is a really vital first step, but taking ultimate control through self-custody, that's a journey definitely worth exploring. Thank you so much for joining me in this explainer. I hope this structured look at withdrawal mechanics helps you navigate the digital asset space safely and with a whole lot more confidence.